There are no expectations for a double US rate cut in November anymore, and that's because Friday's non-farm payrolls report came in strong enough to suggest that the US economy is still in a good shape despite facing some weakness in business activities. So that was good news for the US dollar last week, and I'm really curious to see how the green peg will respond when Thursday's CPI figures will come out. It seems that dollar yen is fighting for a bullish trend reversal, so at this video I'll briefly have a look at the pair, and then I will switch to Kiwi dollar as the Reserve Bank of New Zealand decides on interest rates this Wednesday. Finally, I will conclude this video with WTI oil futures as Israel marks its first anniversary of the October 7th attack. So let's have first a look at dollar yen. The headline USDJPY number is expected to slow down to 2.3% year on year. The core measure, which excludes food and energy prices, is expected to come in stable at 3.2%. So any negative surprises, any downside surprises there may bring some weakness in dollar yen. In this case, investors may think again about double rate cuts, and consequently dollar yen may break the 148.11 support territory, which is currently keeping downside movements in control. This is where the 38.2% Fibonacci mark of this down leg is located. So a fall below that level may take us down to 146.43, where the 50-day exponential moving average is located. Slightly lower than that, I believe that there might be a tougher battle between 144.85 and 145.45, where the 23.6% Fibonacci mark as well as the support trend line from January are located. So any steps below that region may cause some more aggressive declines, probably towards 141.60. If we look at the technical indicators, well, we can see that they are still sloping upwards, but the RSI is very close to 70 and the stochastic oscillators already above 80, so that suggests some caution on the upside. Nevertheless, if CPI figures beat forecast, if they come higher than expected, even questioning the case of a 25 basis point rate cut in November, that could take dollar yen up to 150.75, 151.75 region. This is where the 50% Fibonacci level is placed. So it may, this region may attract special attention before we move towards the 143.40, 154 region, which includes the 61.8% Fibonacci number. A break above this support trend line from January 2023 would officially mark a bullish trend reversal in the short-term picture. Now looking at Kiwi dollar, well, the Reserve Bank of New Zealand is widely expected to announce a double 50 basis point rate cut on Wednesday. This is already priced in, so the focus will turn to November's meeting, and particularly investors would like to know whether there is a probability for another bold 50 basis point rate cut during November's meeting. This scenario, well, futures markets provide 67% probability for this scenario. So if policymakers back this case, Kiwi dollar may continue this rapid downfall, which started from a 9-month high of 4.6377. The 200-day moving average could act as support in this case around 61. If not, then some stability could emerge near 0.6045 and then down at 0.5975. Well, according to the RSI, the risk is skewed to the downside. However, we can see that the stochastic oscillator is already well below its 20 oversold level, so that suggests that downside movements might soon lose steam. If the price manages to cross back above its 50-day moving average at 0.6165, then the price may again retest the 0.6220 and 0.6235 region, where a couple of trend lines as well as the 20-day moving average are placed. Successful battle here could take us up to 0.6290, where this thin long-term line from July 2023 is placed, and then higher than that, all the attention will turn to this short-term resistance line at 0.64. And finally, concluding with WTI oil futures, WTI oil prices reversed swiftly to the upside last week after headlines suggested that Israel is planning to strike oil facilities in Iran. Uncertainty remains about whether Israel will proceed with that action despite the US government opposing this scenario. Nevertheless, uncertainty around geopolitics in the Middle East will keep supporting WTI oil futures as airstrikes between Israel and Tehran allies intensify. We can see that WTI oil price is currently testing the 61.8% Fibonacci retracement of this down leg over here at 76.40. The 200-day moving average could also be restrictive near 77.16. So for a bullish continuation, the price must break this line over here to head towards this resistance trend line and the 78.6% Fibonacci mark, both around 79.60. Higher than that, if the 81.50 territory proves easy to pierce through, then all the attention will turn to July's high of 83.60. Well, if you look at the technical indicators down here, they are all sloping upwards, but the stochastic oscillators are already above 80, so upside movements might face some limitations. If the price pulls immediately near 76.40, then it may reverse to the downside to test the 50% Fibonacci of 74.14. Then below that, the 72 and 72.50 region might be critical because any failure to rebound here would bring this down leg back into play. The 38.2% Fibonacci mark, the 50-day moving average are all placed here. So failure to rebound here could confirm additional losses, probably towards the 23.6% Fibonacci of 69. Then lower than that, the 67 territory could be the next destination. So that's everything I wanted to share with you guys. If you like the video, please subscribe to this channel. And if you have more questions, you can always visit our XM research page. So that's all from me today. Thank you for watching and see you next time.